Thanks for giving us the chance to give you a taste of the paper. And I think this work connects very nicely to previous work we have seen, like where, I mean, for example, Florian's work, where say that there's a good model, but we have, for example, a black box critique out of it. And this is, of course, like a general problem with, say, for example, machine learning models. And today I propose, like I show you like a general way how you can address this black box critique. And it's I mean, as I said, it's very general, so it applies not only to machine learning model, but actually in every setting where you face this kind of issue that you're not really knowing what your model does. So we already saw it in many kinds of settings here. What may be the pros and cons of machine learning or statistical learning is just another word compared to conventional approaches. Things that like you often get like higher accuracy. You do not actually have the risk of misspecification in a non-parametric setting. And as I will show, you can then potentially retrieve like a larger information set. The cons are like higher model complexity, black box critique. There's generally very few, if any, kind of usable analytical guarantees. And depending on the model you're using, for example, large neural networks, you have large data requirements fitting the model. So what's the proposed workflow? It's basically adding on top what you would usually do, basically doing a little bit of post-analysis to kind of rework and understand what your model is doing, and then show you some standard ways of communicating this. So the three steps are like model comparison. For example, is this then worth doing machine learning in the first place? The second step is model decomposition using Shapley values. And I would argue like there are many decomposition ways of models. I think Shapley values, which come from an analogy from cooperative game theory, are probably the cleanest and best defined measure to do this. And then the third step, which is like a separate paper written 2 years ago, is proposing like a statistical inference test on Shapley values as generated regressors for kind of inference and standard ways of communicating results. So what do we do here? We demonstrate basically this workflow in a kind of standard forecasting setting. So we forecast year-on-year changes in US unemployment on 1 year horizon. We use this fairly standard ThreadMD database. We do not deal here really with the high dimensionality of the data set and address this problem, but we just handpick 9 variables which we think capture different economic processes. We do like an out of sample expanding window forecast horizon, initial training and validation period, and then expanding window testing, and compare different models like machine learning, panelized regressions, AR, and the rest is like standard hyperparameter tuning and model aggregation. So first step, the results are basically, I mean, what other people already said, that often machine learning models perform good or best, depending, I mean, also the period one looks at, and particularly about, we see this around like structural breaks or times of, say, economic turbulence. And for example, in our sample, we find that most of the, or all of the machine learning better performance is related to the after global financial crisis period. So step 2 now, model inference, Shapley value. So the first thing you can do is to get a local decomposition, you can re-aggregate those. And what you can do is say, what does every model see? Do they agree? What kind of is the importance of different variables? And what you see here is basically normalized absolute Shapley value share across models ordered by the random forest, which was the best performing model here. And you see that most models agree roughly, but there are some differences, which is of course due to the finite sample and the different types of convergence of the model. Say one example where we see the machine learning models kind of disagree from the linear regression model is the importance of stock market changes for unemployment. And what we see here basically is kind of using the local properties of the Shapley decomposition, that what is the functional form the model has actually learned. So for the linear model, it's obviously it's a line. But when you look at the random forest and we plot, what we plot here always is input values versus model decomposition output values associated with a variable. Here it's the stock market change, like S&P 500 change. And what we see is that on the left-hand side tail, the linear and the machine learning model, like random forest, roughly agree. While on the right-hand side, we see like a saturation of the effect of changes in the stock market on future unemployment. We see that like large changes in this, like upward changes, increases in the stock markets do not necessarily translate and larger decreases in unemployment as suggested by the linear model. We see that basically there's a more nuanced picture of the machine learning model extracted by
1 minute, Andreas.
by the Shapley values. Yes. So very quick two additional things. I mean, as well as was already flagged by Anna Gavau before, we see also very strong non-linearity in unemployment as a left variable, basically a U-shaped form. And when we then extract this kind of U-shaped form and differentiate between recessions and non-recessions, we basically see that the machine learning model learns about the recession as a different state and gives us like a second arc here of say the economic cycle extracted, and we test this with including a recession dummy. Final, I told you like at a step 3, you can input this into like as a generated regression setting, like say an auxiliary next step regression on top of your machine learning or other model you would like to use, and then using kind of regression of this Shapley value generated regressors, you can then do classical inference. The only thing which I do not explain here, there's a little bit of a different way of communicating coefficients because, of course, non-linear models do not have coefficients, and there's a other normalized way proposed here in doing this. And with this, I finish and say thanks for having us and happy to take any question privately afterwards. Cheers.